take a sort of a broad overlook and cover some of the themes, but obviously we've got some real specialists tonight as well, so I won't go into too much detail for areas I think that they will cover. So again, just a reminder, we don't offer advice. So I thought it'd be a good starting point was to just get sort of quick look at what the GDP expectations are for various parts of the world, and also on a sort of a global basis. So on your screen, you can see China is expected to have decreased GDP growth rates there. Obviously, it's been an issue for a while, but I'll touch on some stuff about China in a second. Germany looks like it's going to improve from a very low base. Japan looks like it will have a slightly better year in terms of economic growth next year than this one. The UK is showing progressive growth there. The US actually it's sort of a little pullback next year, and then sort of very flat on a global basis. It's important to sort of say GDP growth figures they're not sort of an exact indication of what will happen to stock markets there, but I thought it would be worth if we just try and remember those figures as we sort of touch on a few things going forward. So what I'll do is I'll go through the bull and bear case for 3 territories, just give you sort of a flavor about what's going on. So we'll start with America. So ever since Donald Trump won the election, again, I think the stock market seemed to welcome his appointment. US stock markets have recently hit a new record high. Businesses like the prospect of looser regulation, lower taxes. Donald Trump has got the sort of the economy at the heart of his policies. And when he was previously president, he did talk about the stock market quite a lot. He tends to be seen as a sort of a barometer of his success. So I imagine that if the US stock market continues to sort of move higher, he'll be I'm sure he'll be taking all the credit for it. But if the US stock market goes through a more difficult patch, I wouldn't be surprised to see him pay close attention to see what he can potentially do to address what some of the sort of negative issues might be. And there are negative issues. And I think that if you look at some of his policies, first of all, the clampdown on illegal immigration could push up labor costs for quite a lot of companies in America. And his threat to impose tariffs on goods made outside of America imported into America is a big issue here. So you've either going to have American companies who've been buying cheaply from abroad might find that what they're buying is more expensive, or if American companies are encouraged to buy from American manufacturers, for example, they might find that those are that's more expensive as well. So inevitably, all these extra costs will just be pushed on to the customer, and that could drive up inflation and ultimately keep interest rates higher for longer. So at the moment, the markets are expecting the Federal Reserve to cut rates tomorrow, potentially to cut rates a couple more times next year. But the narrative is shifting. So in terms of we might not get rapid increases we previously thought in terms of cuts. Trade war is not something that I don't think any investor really wants to see, and it's a key risk here. And I think at the moment markets tend to be in sort of a celebratory mood going into next year. It's something to keep an eye on if the narrative shifts. And the other thing to think about is, US markets are quite highly rated at the moment. Obviously, that will therefore require, strong earnings growth to keep driving those markets up. And if we don't get that, there obviously is the risk there that markets might go through a little bit of a wobble patch. We don't know, we can't predict it for certainty, but it's something for you to consider. Now, there's some similarities with what's happening in the UK as well. We've got a new administration. They've got policies that they think will drive economic growth. Unlike the US, UK stocks are cheap. And that would be quite interesting. If we see a wobble in the US stock market, it might shift a bit more attention onto the UK, where there are some sort of bargains to be had. And in the summer, we had some changes to the listing rules. So there's a potential for more IPOs next year. And I think investors often quite like to see new companies joining the stock market, gives them new ideas. I got this sort of impression that a lot of people were waiting for the general election lots of companies waiting for that general election before they press the button on committing to an IPO. It normally takes about 6 months from making that decision to float on the stock market to then appearing. I wonder if we have some companies who just waited for the budget. So I think this all points towards there being next year we could see an increase in IPOs, but it might not happen until a big increase until the second half of the year. So the bear case for the UK is that it's still unloved by many investors. Shrinking market is definitely an issue. We've had lots of takeover activity or companies deciding to delist or shifting their listings to other places, like particularly the US. And ultimately, the Labour government hasn't really gone down that well in terms with the business community. It always warned that if it got in the election, it was going to make difficult decisions, and it's basically delivered some real cost pressures for business going into next year, and that sort of soured sentiment a bit. I mean, the FTSE 100 has kind of been stuck in a trading range for about 6 months now, and so it's something that we can talk about perhaps in the Q&A session. What would it take to get the UK market moving upwards again? And just finally, I wanted to touch on about China. So the government here is concerned that economic growth is slowing. It's announced in recent months a big economic stimulus program. There's been some tentative signs of positive manufacturing data. On that level, I would say that there's a potential for, because we've got this threat of really big tariffs from the US on Chinese goods. It does seem like some orders have been sort of pulled forward. Lots of perhaps American companies have been ordering from China before those tariffs come into play. So it's making manufacturing data look quite good at the moment, but whether is it giving a sort of a false impression of what things are going to be like going forward? And there are pockets of the market that are still quite cheap. China's been unloved for ages, and whilst it's had a bit of a sort of a boost since these stimulus programs have been unveiled, still areas of opportunities there. The bear case for China is that historically, when we've seen government stimulus initiatives, they haven't had a long-lasting impact. And there is a risk that is going to be the same situation once again. We saw some pretty miserable retail figures recently. The government wants to get the economy driven more domestically. Consumer sentiment still seems weak, so it's not a great sort of starting point as we move into the new year. Of course, those tariffs, if they come as threatened, they could really hurt Chinese companies that export goods into America. And so those are some of the key themes, and obviously we've got our experts talking in a bit. We're covering potentially some of those things. So I wanted to sort of touch on 3 of the key investment themes I've seen this year that have caught people's attention and where they might be going into next year. Some things for you to think about. So let's start with artificial intelligence. Some of these stock names, just some examples on the screen, are showing that how this year, and actually for the last 2 years, we've seen some really strong share price gains from everything linked to AI. Now, I would argue that the opportunity is very well known now, and it's kind of due for a little shift in the areas that could get investors' attention. We know that semiconductors are, the demand is huge, and they're struggling to keep up with supplies. This does seem like old news now. We've seen that sort of a slowdown in the sort of the share price gains for people like Nvidia recently. Investors are rightfully asking, saying, hang on a minute, you're spending loads on capital expenditure. When we're going to see these positive financial returns for all things AI? We had the 2-year anniversary of ChatGPT the other day, and I thought actually I had a sort of closer look to see what impact it had on companies. And actually, it's perfectly timed for what we're sort of talking about today. This shift in where I think that investors will start looking. We've had some early adopters of AI, giving sort of tangible evidence of how it's affected them. Klarna is a really good one. It was talking about using sort of chatbots to answer customer queries. You get in touch with Klarna, you think you're talking to a real person, but you're not. You're talking to a Gen AI chatbot. Klarna says it's essentially doing the work of hundreds of call center agents really quickly, and that actually the information that customers are getting is exactly what they want, because it's seen a big drop in sort of follow-on questions. Meta has been using AI to essentially help improve the sort of suggestions for video reels on its social media networks. The idea is if it keeps offering more stuff it thinks is relevant to people, they'll stay engaged for longer. And of course, if they're staying longer on the social media platforms, they're being served more advertising, more income for Meta. So I think this is what the market will be looking for next year. They want more examples of this tangible evidence that AI is having a positive impact on companies. Those companies that can show this evidence are going to be the ones that will essentially grab investors' attention. And I think that equally, the ones that can't show any evidence, they might start to find themselves, on the wrong side of discussions with investors, and people sort of suggesting, why aren't you showing this evidence? So I think we'll see the shift from enablers to users. This is my personal opinion. Again, can't emphasize enough. This is, we don't know what's going to happen. It's just what I think will happen. The second topic is weight loss drugs. Now, Eli Lilly and Novo Nordisk have a sort of duopoly at the moment here. They've had some really strong share price gains over, as long a 5-year period. The growth seems to sort of stalled again, and I think we're going to see sort of a shift in what's going on. So Novo Nordisk is Wegovy, Ozempic. Eli Lilly is Mounjaro. The demand is incredibly strong at the moment, but I think investors are sort of thinking a bit more long term here about a couple of things. One is that pharmaceutical companies, when they discover something new, they can get a patent, they get protection for a certain amount of period. When those patents expire, copycat companies can come in, essentially make a copycat version with the same active ingredients and sell it for a lot cheaper. Novo Nordisk has got the 2031 patent cliff. Now you think this is years away, but for some long-term investors, they are starting to think, okay, well, all right, what's next in Novo Nordisk's pipeline? Because there's competition coming. Lots of other companies are trying their best to create new weight loss drugs, including Amgen, AstraZeneca, Pfizer. And key to success here is creating a drug not only is sort of effective at helping people to lose weight, but also we want to see drugs that have fewer side effects, because at the moment the ones on the market are causing slight problems with people. They're not staying on, some people are not staying on these drugs for a long time because they don't like the side effects. So this leads us to what Novo Nordisk is doing at the moment. It's got a new sort of generation product called CagriSema. It thinks it could cut weight loss by 25%. So that the promise sounds interesting, and the company was quoted in the Financial Times last month saying it thinks it should have late stage data to back this up due this month. So we could get this any day. Now, I've been speaking to a few fund managers about this, and they're slightly concerned that if CagriSema doesn't live up to expectations, Novo Nordisk share price could have a quite a big wobble. And so I certainly spoke to a fund manager the other day saying that they see it a bit of a binary bet, and that's not what they want from an investment like this. They want to see a bit sort of smoother share price activity. So definitely want to keep an eye out for in terms of sort of news flow from Novo Nordisk. And finally, I just want to talk about UK takeovers because there's been a lot of activity this year. You've had some really big names receive bids, and quite a lot of them have gone through or are in the process of going through. You've had 5 FTSE 100 companies and 19 companies in the FTSE 250 have received takeover bids. For various reasons I'll come into a minute, but one thing I thought, just a key observation I thought everyone's watching this webinar might be interested in. I had a look at some of the companies which managed to fight off takeover bids. I looked at Anglo American, Rightmove and Currys. Now, all 3 of these stocks now trade on a higher multiple of earnings than they did before they received takeover bids. It's almost like people have gone, okay, well, you know, they've received a takeover bid. Why is everyone excited about them when they perhaps weren't before? And if they've managed to fight off bids, you know, where does this stand now? It kind of means that investors are prepared to pay a little bit more to own these shares. It doesn't apply to all takeover bids that have been fought off, but it's a little trend probably worth keeping an eye on. The average takeover bid, when I put this presentation together a couple of weeks ago, it was 49%. We've had a few things since, and I think the average is about 46% now. But what it means is that people are getting paid a big chunk upfront to, you know, as a sweetener to try and, you know, buy the bidder to, you know, convince them to say, yes, I'll accept this bid. The FTSE 100s, if you include dividends this year, you're probably looking at about 10-11% return, total return. So in effect, you know, these takeover bid premiums are offering you 4 years worth of average UK market returns up front. And I think obviously you can see why a lot of bids have gone through, because I think investors are finding that pretty compelling. So I had a quick look at why these takeovers were happening. There's various sort of reasons. One is that it takes the buyer into a new country. I mean, we see that over the years. That's a perfectly normal reason. Another one, increasing market share or scale. Obviously, Nationwide bought Virgin Money. That increases its, you know, scale and market share. We currently got International Paper buying DS Smith, the FTSE 100 packaging company. It's the same reason here. Some of the other ones are the market, you know, looks like it's a bit of a blind to the value on offer, and this is sort of where you've had companies that are essentially the share price sort of drifting sideways for ages. You know, lots of investors aren't just not really interested in it, but as a strategic buyer, obviously has been sniffing out this opportunity, and this is why we're seeing it on quite a lot of takeovers at the moment. So I thought, you know, with those things in mind, just look quickly at a couple, you know, 3 different potential takeover targets. None of these are in takeover situations, but they have some of the qualities that sort of tick the right boxes if you look at what's happened with previous takeovers. JD Sports. So we've got the share price slightly weak at the moment. It's had a couple of warnings this year. The valuation is very cheap at the moment. It's a major player in tracksuits and trainers market, in the retail market. So you could see why, if someone took a really long-term view and wanted to own one of the key players, why JD Sports might appeal. Whitbread is in another similar situation, so owner of the Premier Inn hotel chain. It's not got a dirt cheap valuation, but you know, Premier Inn is like one of the key hotel brands in the UK. It's rolling this brand out in Germany. It's quite small scale, but the growth looks quite interesting. But the share price has sort of, you know, ground to a halt recently because people are concerned about UK growth being very slow. So I think one of the things that might work against it in terms of a sort of a takeover target is its valuation is perhaps not cheap enough for someone to sort of jump in. But again, one to keep an eye on. And then finally, I just want to talk about WPP, who is cheap valuation. Trading conditions are quite tough for the business. Share price is definitely struggling to move higher. We've actually got some takeover activity in its sector. So all on those sort of basis, ticking some boxes that you would expect to see for, you know, qualify as takeover, you know, a candidate. The only thing that strikes me is that could potentially hold, you know, this one back is that structural changes in its market. We're certainly seen some really big brand companies that are, you know, using AI to create things themselves. Do they really need to use WP as much? We've also got people like Alphabet, that owns Google and Amazon. They've got really data-rich platforms. They know a lot about their customers. You know, they're going directly to big brands and saying, "Come and advertise with us." You know, is sort of someone like WPP, the traditional ad agency, is it essentially old? You know, is it become too old? It needs to change its business model. So again, these are sort of things that, you know, excite me, that get, you know, you get your brain ticking over when you're looking for opportunities. And we obviously we've got a UK fund manager giving a presentation a little bit later on. It'd be interesting to see if they've got any thoughts on takeovers in their presentation. If not, we can talk about that in the Q&A session. So that's everything from me for now.